So good afternoon, everyone. And today we are happy to have David Blanchflower and Alex Bryson with us. And Alex is a professor of quantitative social sciences at the UCL Social Research Institute. He is applied labor economist who also works on well-being, predicting economic downturns, and a lot of other various interesting topics. And David Blanchflower, who's also with us today, is a Bruce Rauner Professor of Economics at Dartmouth College, and he's also a labor economist, and he did a lot of important work on happiness, whom all of us, I guess, referenced extensively. So we're happy to have both of you here today, and the floor is yours. Please let us know if you're fine with us asking questions in the middle, or if you would wish us to wait till the end.
Yeah, thanks, Katya. So I'll present and Danny will definitely interject, and please feel free to ask questions as we go. Can you see that on the screen?
Yes.
So, okay, this is primarily a paper about unemployment and whether we can predict it rather than directly about well-being, but I will be showing some stuff on life satisfaction. It's one of a number of papers Danny and I have been writing on trying to predict unemployment and getting information on people's expectations about the future and whether that is indeed predictive of downturns in the economy. So those are the web-linked papers that I'll be referring to, but I'll be primarily referring to this top one here, the first in the series. So the motivation is pretty straightforward. I don't need to tell you guys how bad unemployment can be for individuals, both in terms of health and well-being, over and above the income effect. And of course, it can have scarring effects into the future on labour market prospects, but also for society. So Richard Layard has talked about this rather a lot. And so, of course, there's a premium on seeing it coming. Why? Well, policymakers might be able to mitigate the worst effects of unemployment if they can see it coming and adjust policies accordingly. And they can also avoid making the wrong policy adjustments, something that Danny's been directly involved in the past as a member of the Monetary Policy Committee. But predicting economic downturn has proved really hard to do. And I'm going to talk a little bit about that. Of course, we'd expect it to be hard to do because we think as economists of economic downturns as often a random shock, which by definition should be quite hard to predict. But the efforts to do so have been made somewhat harder, I think, by the nature of the data that people have ordinarily had available to them. Those data are not normally up to the job. They are, as I'll argue, in some respects, the wrong types of data, and they are low frequency. Sometimes efforts have been hampered as well by people looking in the wrong place for predictors. In particular, there's been a whole literature on institutions in understanding cross-country impacts of institutions on economic downturns. So that literature is very substantial, very heavily cited by economists, and has some top hitters, as well as Richard Layard, Steve Nichol, Charlie Bean, and so on, all arguing that institutions caused or exacerbated recessions. And so you'll see the literature on things like high unionization, high unemployment benefit rates, leading to nominal wage rigidity, which is bad news for the economy. Many of these studies are time series country level studies. They have a small number of countries and a low frequency in the data in terms of country year cells. So in the late 90s and early 2000s, this literature came in for heavy criticism. The results were not robust to the inclusion of country and year fixed effects. Danny contributed to that very early on, but you'll see James Heckman, who Katya was just referring to, also did so, and so did Richard Freeman. And indeed, recently, work by people like Ken Mayhew has argued that those who were thought to previously have the wrong institutions, highly protective regulatory regimes, actually did rather well in the Great Recession. We're going to contribute to this literature by focusing more on the expectations of economic actors on the ground, consumers, employers, and workers. And we're going to use their expectations about the future, in particular their fear of unemployment, we'll focus on heavily. And the fact that this seems to be predictive in a simple statistical sense of subsequent unemployment shifts. And furthermore, predictive over quite a long period, 6, 12, even 18 months before changes in unemployment. We can do this because we have high frequency data monthly over a long period of time in some of our data sets going back to the 1970s. So we can capture multiple downturns. And we have standardized items across Europe and within North America. And in some cases, so we plug in country fixed effects. So we're looking within country over time. And in the United States, although I'm not going to present much on this today, we have some state level information as well from the conference board and so on, which we use because that captures expectations state by state. So we can link these expectations to multiple definitions of downturn. I'm going to talk briefly about the use of GDP as traditionally being used, but we're going to focus primarily on unemployment as an indicator of downturn. What do we find? We find expectations regarding future labor market prospects, changes in unemployment and employment, perceptions of your own household finances. These are all highly predictive of economic downturns up to 18 months later. And this is true in most countries and for most or all economic downturns going back to the early 1980s. So you think this is strange. Actors seem to know things which forecasters often miss. And this is what Danny has coined the economics of walking about, knowing things by virtue of being in the labor market and economic transactions. You can
can I just say one quick thing? I mean, the reason this is so important is that this is ex ante, trying to think about what happens to unemployment. But if you think of things like the NBR Dating Committee and others, that's ex post. And so they date, for example, they date the start of the recession in December 2007 in the United States, in December 2008. So this is actually completely different from that. This is trying to think about, could you predict it ex ante, not forecast it ex post, which is what much of the literature is actually about. Sorry, I didn't mean to carry on.
So we'll show you a chart, for example, which shows, it plots fear of unemployment 12 months hence, where people are asked, what do you think will happen to the labor market 12 months hence, against what actually does happen 12 months hence. And you'll see this phenomenal correlation. So furthermore, even though these expectations of different actors are quite highly correlated, consumers, producers, and workers often think similar things are going to happen. They actually have independent effects in a regression analysis. They all hold their predictive power. We show that these things are true in Europe and North America, even though there are fundamental differences between the way output and the labor market react to one another across Europe and North America, and I'll come back to that. So we think it's quite a good idea to use changes in unemployment as the dependent variable, and we talk about this quite a lot in our papers. One of the main reasons is that unemployment is less prone to continual subsequent revision compared to changes in GDP that are frequently revised. And in particular, the measurement error is worst at turning points. So there are big problems using real-time GDP data. So the implication of all of this, we think, is that policymakers should pay more regard to these qualitative survey metrics when forecasting. So I'll talk you through now the first of these papers. This will be the primary focus of the presentation. What we do is we predict changes in unemployment rates using lagged expectations data. And we have these data, and you'll see the web link for here. the EU harmonized business and consumer surveys. You can click on that and download the data yourself. 29 European countries going back to the mid-1980s. It's an unbalanced country month panel data set. So we have 439 months and over 10,000 observations. And then all of our estimates, we have country fixed effects. Remember the thing that led to the lack of robustness in the earlier literature. And we condition on lagged unemployment rates, which are not surprisingly highly predictive of future unemployment. So our focus is on individuals' fears of unemployment, their perceptions of the economic situation and their household finances. And I will show you the exact question wording in a minute.
Yeah, country fixed effects and year effects and lagged unemployment.
And year effects, that's right, yeah. And so we predict the Great Recession. In fact, one of our papers is almost exclusively focused on that. And we've started to argue, and I'll come to this at the end of the presentation, that it looks like the US may currently be in recession, if you believe the way we're doing things, even though most commentators don't think so. It's also true on the business side. So I'm talking about consumers and workers and their expectations. But if you look to firms and business sentiment, this is also predictive of unemployment 12 months later. And in the last bit of what we do in this paper, we also show that fear of unemployment lowers life satisfaction over and above the direct impact of unemployment itself. And we do this with a 29 country annual panel data set going back to the mid-1980s. So this literature has to grapple with what should the dependent variable be. When we think of recession, most people think of a downturn in output, and specifically 2 consecutive quarters of negative growth. But there are big problems using GDP as our metric of interest because it's continually revised. Danny has a horrible story about the 2008 recession when he was arguing that we were in recession and his colleagues on the Monetary Policy Committee didn't believe that they were. And ONS, right in the middle of all this, issued a quarterly GDP change of 0.6% up. Turns out that actually now, if you look at the most recent version of that number, it's a big fat negative, I think a minus 0.5. Danny was right back then, but we've only discovered it years later. So there are real problems with using changes in GDP. And the error proneness of these measurements is greatest at these turning points. They also don't come out very often. And quite often we only have output at national level. Changes in unemployment, on the other hand, are less susceptible to revision. Not always. COVID has been a particular problem in this regard, given what's been happening with furloughs and the like. But the revisions are much less problematic than for GDP. The data have greater frequency, are available more quickly, and are available at different levels of disaggregation as well. So some people like Sam have used these to capture turning points. So in her case, she looks at a 0.5 percentage point rise in unemployment rate relative to the low point of the last 12 months as her measure of capturing turning points. Now, when you move from output to labor market metrics to capture downturns, you do have to recognize that the US and the European economies are somewhat different. Why? It's because the US labor market responds much more quickly to changes in output than European economies do. So you need to bear that in mind. That's quite often why we think the US is often the lead indicator of the world, and that's what we think might be going on right now. These are the ordinal expectations metrics that underpin many of our models. So the first 3 here are asked of consumers and workers. So how do you expect the number of people unemployed in this country to change over the next 12 months? And a clear expectations metric. And I've given a little bit of detail as to why the score goes from -100 to +100. We also use these other qualitative metrics about in the moment. How do you think the general economic situation has changed over the past 12 months? Turns out that's also predictive of what happens 12 months hence. So is perceptions of one's financial situation. You can also go to producers and firms. That's the last question at the bottom here. How do you expect your firm's total employment to change over the next 3 months? Notice 3 months, not 12 months. And notice the change in sign here. They're asked how they expect employment to change. So when you see us using a firm level expectations indicator, the sign should be the opposite of the one for consumers. So sorry, that's a little bit confusing. Those are the basic types of metrics we're using here. In other things that we do in other papers, we're using data for the United States from the Conference Board and the University of Michigan, and those look slightly different. Now, here's an example. Here's a picture of what happens in the UK over the period of interest. So we've got 2 lines here going from March 1985 right through to March 2020. And what you can see is the fear indicator. This is the proportion of individuals who are saying that they're really, really worried about the labour market 12 months hence. And you'll see it peaks here in just around, what's the exact date there, Danny? Is it March?
Yeah, it's March 09.
March 09.
People understand, we plotted the unemployment rate 12 months ahead, right? So you've just moved the whole series. So yeah. the March 07 fear data is plotted against the March 08 unemployment rate, because it's asking, what do you think unemployment is going to be 12 months ahead? So we just, we plot the 2 things together.
So you see a very strong correlation between the 2, which, as I'll show you in a minute, survives in most places most of the time across most countries in the regression context.
Can I just say one thing, Alex, as well? Could I just go back quickly? Of interest actually is also this. So this turns out both in Germany and in the UK, even as the unemployment rate is falling, the fear of unemployment series picks up and is predictive of a rise of the unemployment rate prior to the onset of the lockdown. So that's true both in the US and Germany. We're looking in other places, but this seems to be a pretty interesting. So in both places, unemployment rates are falling, fear of unemployment series rises, and then that predicts about, a little bit later, the series itself picking up. So that's pretty interesting, which we're working on in other things.
Thanks, Danny. So starting on the empirics now, this is the old style estimation, right? So remember the old literature I talked about. So admittedly, we've got employment and unemployment as dependent variables, but these are state year panel data. And you can see lagged unemployment rates, very highly predictive of subsequent unemployment rates. Union density, what happens to that? Remember, the old literature was, unions could be bad for the way the economy responds to changes in demand for goods and services. Well, yes, if you don't plug in this case, state fixed effects. But as soon as you go from column 2 to column 3, where the state fixed effects are in, bang, no union effects whatsoever. In fact, the sign of the coefficient is going in the wrong direction. The only thing that holds up in this sort of setting for the United States, which is exactly what Danny and Andrew Oswald found many years ago, is lagged home ownership. And if you have a higher percent home ownership in a state and changes in that within a state over time, that's predictive of worse labour market outcomes. That's because it's capturing a degree of friction in the economy. But by and large, these sorts of models are not very good at predicting what happens to unemployment and changes in economic conditions. Now let's go to what we actually do in most of our paper. And what we find is here we've got unemployment, and this time round we've got it from 1985 right through to 2021 for all countries pool, but remember, we've got country fixed effects in here, we've got year fixed effects in here. And the first equation, again, across the piece, we've got lagged unemployment rates, which are highly predictive of subsequent unemployment. But in the first model, we've just got fear lagged by 6 months. Strongly statistically significant. If you replace it in column 2 by fear lagged by 12 months, still there. Put them both in, they still have predictive power. Bring in the economic situation, perceptions of the economic situation, things going badly, again, that predicts independently. And in our final, I think possibly favored column here, you can see these things all having independent effects. So quite surprising, arguably. Not many people have used the data like this before, and it does seem to be quite persuasive. Even more so.
Alex, can I just go back to that? I mean, what's really interesting about this last row, this last column, so the fear variable Alex talked about by industry, it's available for industry, construction, services and retail. So here we just take the fear of manufacturing production firms. Obviously, there's more that you can do, but that has a negative sign, which is the right sign, because it says, you know, in bad times, we're going to lower employment. But here, I think Alex has sort of understated it. I mean, it really looks like even these things are sort of orthogonal to each other. You get the fear variable, you add the industry fear variable, that works just fine. And you say, what did you think about the economic situation 12 months ago? With country and year fixed effects in there, this looks a lag dependent variable. I just think, you know, I agree with everything Alex said, but I'm just like, holy moly, this is amazing, especially given how hard it is. I mean, I've spent a long part of my life trying to estimate unemployment equations, and you can't get anything to work in an unemployment equation with country and year fixed effects in it. I mean, you know, obviously the home ownership rate lagged, but basically in Europe, you can't get anything to work. So the fact that all these things work, I think it's completely a wow to me. Sorry, Alex, good job, mate.
Oh, thank you, thanks, Danny. Then if we look at unemployment by country, so these are country level estimates now. So you see the ends in each row are for the number of months for which we have observations for that country. Here, take the UK at the bottom here. Again, we're trying to predict unemployment rates in that country. We see the lagged unemployment rate is a very powerful predictor. But so too are consumers' perceptions of the general economic situation. You can see their fear of unemployment 12 months lagged is of profound importance. In this particular case here, the last variable that Danny was referring to, the industry fear stuff, is doing diddly squat. It's doing absolutely nothing. But in other places, it absolutely is. And indeed, if you pool all of the data, you see it's doing exactly what we expect it to do. I think, if I remember correctly, in about half of these countries, all three of the sentiment indicators are statistically significant and going in the predicted direction. Perceptions of general economic situation, fear from consumers and fear from industry. In about half the others, one or other of them is doing what we'd expect it to do. One or two of these countries are a bit dodgy because they have a very low N and they're small countries. So we do a bit of aggregation and see what happens there. And again, we get similar results. And then here all we've got here is just a variant of this where we're bringing in a wider set of sentiment indicators just to see what happens, just to underpin the robustness of these results. Even though many of these sentiment indicators are positively correlated, they all seem to have independent, statistically significant effects, as you would expect them to, even over and above lagged unemployment rates. So again, we've got the fear indicator lagged by 12 months. You can see how pretty robust it is. Similarly, if we switch to industry, we've got industry fear in time t, but also lagged by 12 months. Again, always statistically significant. Financial situation is people being asked about their household situation. Again, lagged 12 months, it's doing stuff. Asked about the economic situation, same. And here are some consumer confidence indicators as well, again, proving very important. These are the big things in the United States because, if I remember correctly, they don't have the fear of unemployment indicator. So most of our American papers are about consumer confidence. Then finally, just show you from this paper, a life satisfaction equation, an ordinal scale, asking people about their life satisfaction. We've got life satisfaction lagged by a year, very strong. But we've got unemployment rate, also negative and very strong.
Just say, Alex, that these are country year cells.
Country year cells down the bottom here, about 700 or 800 of them, yeah.
So it's country year cells with a lag dependent variable, country effects and year effects. Sorry.
Yeah, that's good. And the key thing to look at is this fear coefficient in the final column. Very strong, very negative, over and above unemployment itself. So then I thought I'd tell you very briefly about, I think this is possibly the most recent paper we've been working on, the here and now in the United States. And here we've been using, this is a really live moment because there's a lot of debate about what's going on in the United States at the moment. Are we in fact seeing recession right now? And here we've been fortunate because Danny's managed to acquire the microdata from the Conference Board, and we've also got the University of Michigan's data on expectations. And what's nice about the Conference Board stuff, I think, is it's not only at national level, but we've got it for the 8 biggest states in the United States. And what we show in this analysis that these expectations, again, predict downturns up to 18 months beforehand. In particular, when we look at the data, what we find is that in general, a drop of 10 or more points in these indexes tends to indicate we're moving into recession. It's not the only indicator that does that. Another one we've discovered is a 0.3 percentage point rise in an unemployment rate. So this is what we find. What we've got here, you'll see, is we've got data right through to August 2021, and we've been looking at this with some great interest. If we try and predict monthly unemployment rates in the United States for this period going right back to 1978, you can see, once again, not surprisingly, lagged unemployment rates are in there. But look at what happens to the Conference Board expectations indicators. As I say, these are the sort of more like the consumer confidence stuff, coming in as strong, negative, and statistically significant, as we'd expect. That's true if lagged by 6 months, if lagged by 12 months. And it's even true if you bring in another survey on expectations, the Michigan expectations, you'll see it's doing the same thing. And indeed, yeah, you can even put the Conference Board and the Michigan stuff together, and you also find them both having predictive power. So what we're arguing is, well, this seems, on the basis of what we've done, that recessions might not be quite so random as we thought. Why? Because people have expectations and they seem to be predictive of these things. It's akin to the wisdom of crowds, and it certainly, I think, strongly underpins Danny's idea about economics of walking about. So we think policymakers might be making better judgments about what to do with the policy levers if they start to take serious account of these qualitative expectations. Right here and right now, it's incredibly important. And this table here encapsulates it. It's in a Vox EU blog that Danny and I have done about what's happening in the US economy right now in the context of COVID, because what we're showing is these percentage point drops in Conference Board.
Alex, they're not percentage point drops. Sorry.
No, sorry, they are point changes. Yeah. They are point changes. So if you remember, I said anything above 10 normally implies a downturn in the economy. Of course, back in 2007, these numbers are all well above a -10.
So can I interject? So the reason that 2007 is important is that we can date, if we take the date that the NBER dated the start of recession is December 2007. So we know that we'll at least take their point as the start of the recession. So we'll go back within the year 2007, find the peak of this index by state, and see how much it declines between that peak in the year and December 07. So this is the decline in, expectation points, if you like, of that index between about April, May in 2007 and December 07. So Florida has this giant decline of 64 points between May and December. And obviously in 2021, we don't know the answer of if and when the recession started. So we just take 2021 for the same states, take the peak in 2021 and look at the latest data we have. And we got new data again yesterday with another drop. And we take it from April, May in 2021 to the latest number we have for September. So there you get, and look what's comparable. You have a 59-point drop in expectations. That's about a halving of the index in New York, but in every state, they are bigger than our 10-point rule and look broadly comparable to what happened in 07, which makes us go, holy moly. Obviously, as Alex says, the unemployment data and the wage data and all of that, which we normally get, haven't moved that way. But the one thing perhaps you should say is that what we show in this paper is this is the only set of data in the US that predicts ahead of time the recession, and it does it 6 out of 6 times. And there's no example where it wrongly predicts it. So no other data file does it. 6 out of 6 times it predicts it. It looks like it's predicting it again, could be wrong, but you should be pretty leery of a series that has every time it's ever done this predicts recession. So we have been basically on the basis of these data saying that this looks like recession, and the index keeps going. And yesterday we got another drop in the conference board index, and these numbers are even bigger than that now.
So as Danny said, if you believe everything that we've said till now, then you should take these figures very, very seriously. Although, of course, you could argue that the COVID recession is utterly different to everything that's gone before, because it's not only characterized by a major economic slowdown, there's a health component to it too. And people are truly fearful, and we spend a lot of time talking about that in our papers, perhaps in ways that might make these indices a little more fragile than they had been hitherto, but we suspect not, because Danny's been looking at other indices, such as how much people are prepared to pay for their shipping at the moment, and many of these other indicators are going in the same direction. So what we've done is very simple in many ways, and we need to improve on it. And in particular, you'll notice at no point have we said anything about trying to predict in the sense of using out of sample prediction. And that's what we need to do next. We need to not simply describe the world and argue that these expectations are predictive of what happens next simply by looking at lagged variables. Rather, we need to calibrate our models by splitting our samples into an estimation sample and then predicting out of sample to see whether our results hold. We'll be working with James Mitchell, who's an old colleague of mine at the National Institute, who's now at the Cleveland Fed and is a proper time series analyst. He will be using estimators to identify structural breaks in the data. So we want to see whether the expectations data, if we use James's approaches, we'll simply see whether the expectations data themselves have structural breaks in them and whether they actually relate to what happened in the real world. That's another way of doing what we're doing. And we'll have to do 1 or 2 other things to account for issues of such as serial correlation using time series technique. But these are things that are on the agenda right now. We're doing them right now. We haven't done them hitherto. But I suspect that we're very, very likely to see not dissimilar results to those things that I've shown today. Okay. Thanks very much.
Thank you very much, Alex. Thank you very much, Danny. This is fascinating and also a bit worrying, as in the results that you show. And we have 20 minutes for questions. I see Richard. Richard wants to ask a question. Please go ahead.
Well, I thought it was absolutely fascinating. I guess I've got three sort of questions. I mean, first, when you say this is very good at predicting, you compared it with some other sort of labour market-based equation and showed, I think you showed it did better than that. But what if you're comparing it with the actual predictions of much more elaborate models like the Bank of England or whatever? Fed, have you done systematic comparisons of the predictive power with the actual, your actual predictions, as it were, that you would get from your model with their model? Can I finish my question?
Oh yeah, of course, please. Yeah.
The second question, I mean, these models do to some extent use some of this stuff, do they not? I mean, well, you went on tours when you were at the Bank of England, chatting to people, maybe not walking about, but driving about. Second question, sort of, how different is this? I take it you're not really wanting to say that this is the only thing that should be done, but you're wanting to say somehow it should be incorporated more than it is.
Absolutely.
In general models. But third, I mean, you've been doing this for a while now. I'd love to know what comeback you've had. Anyway, those are my questions.
Can I answer? I mean, Richard, thank you so much. I mean, in a way, it's so much of what you've impacted on. Your impact on all this work is huge. I mean, think of this, Richard, as another way of writing well-being. Right? These are just well-being equations. You're right that there are all these other models, but I guess my whole, the best answer I can give you is look back at the Bank of England in something like June 2008 and the Fed and everybody else. And they had all these models and none of them in any way were predictive at all. And none of them said recession in it and none of them had gotten there. But what really got me, Richard, was that we would have a series of presentations on a Friday at the MPC. And for about 3 hours, the economists would stand up and say there'd be no recession. But then we would get what I got the economics of walking about to be, which were the Bank of England agents, which is exactly what you just asked me about. And the Bank of England agents were walking about the country, and you can go and look at their scores, and I encourage young researchers to go and do it. They produced monthly scores, which were entirely inconsistent with everything that was in the Bank of England's model or the economists were saying. And if you look at those data, it was very clear by March or April 2008 that they were predicting recessions, whereas all the other things were not. So I think you're right. I mean, people did incorporate these, but essentially all of these models missed the Great Recession. The Bank of England agents did not. And if you go in the United States, go look at the Beige Book. I mean, the Beige Book is doing what Richard Layard forever has said, right? They do, the economists are walking about, and each of the districts do this, and there's this huge disconnect. So that's what got us. That's what got us to this, Richard. So people have tried to incorporate it, but they've been extremely bad at it. So I think that was really the starting point. But if you go back and read, for example, the Bank of England agents report in June 2008, they say recession. And the MPC didn't say it, the economics researchers weren't saying it. Same at the Fed, and go read the Beige Books. So that's kind of what got us to this. And yes, there's been a lot of pushback to this kind of work. But I say to people, most of this stuff is because the main models missed it. They have incorporated things in there unsuccessfully. As time is going on, they're getting better, and they certainly are starting to incorporate this stuff. And I think the reason, Richard, is you're spot on, is that those models missed it, and they do realize that these kinds of data did not miss it. So I think that's really
but Danny, can I just ask, I mean, you're picking on this one particular episode, but what if you look at the total predictive?
Yes, of course. Let's go.
Performance of your equation compared with ours.
So the answer is, there is no other data point that essentially predicts well the price. If you just take the 6 data points that the NBR calls as recession, our models predict all 6 of them, and essentially there is no other that gets anywhere close to it.
That's interesting.
So that's the simple answer to your question. I mean, the
The other thing that's interesting is that we've actually presented this to the Bank of Australia, and one of the women on the who Danny knew was in charge of the bank's agents during 2007-8.
Yeah.
And they Australian bank was more than.
Sorry, we lost him. Well, I know what he was going to say. There was we lost you. Do it again, Alex. We lost you.
Yeah, just saying there's not.
We lost him again. I mean,
Australia.
There was so much pushback, Richard. She talked about the fact she was in charge of the Bank of England agents, and she said they just pushed back on it. Look back at those series, and that's what we've been doing, Richard. We've gone back and we said, okay, you look at the 2007-8 one. Let's go before. Let's look at the ones before. The reason it's a bit hard, Richard, is that if you take the NBR dating for the United States, there are several recessions, including 2008, that do not have two successive negative quarters, right? First of all, so they dated in December 2007, not based upon two negative quarters. And there are examples in previous to that have two negative GDP quarters that they don't call a recession. So it's a little bit weird, Richard. So we work on, let's take what they've called, but it's a little bit hard because there's not a simple rule. But the good thing about what we do is our stuff in every case predicts it. The other models get it wrong because of this weird two-quarter GDP thing. So, all great points. We're working more on it, and that's what we've got James working on now. But basically, I think the answer is that our data does much better than anything else. That's
the other place we presented it recently was at the Peterson Institute. And I think before that meeting, you met Olivia Blanchard, didn't you, about this, Danny? Yeah. And he got us onto another issue. He asked a really hard to answer question, which is, where do these sentiments come from? How do people formulate these expectations? And there's a question in the chat here by Shivani, which is along these lines across countries, which I think is a nice one. Does unemployment fear disappear or lessen in countries with really good unemployment insurance systems or social welfare? We haven't looked at that, Shivani. It seems like a perfectly plausible proposition.
But the answer is, however, if you look at the equations, the fear variable works in basically every country. It doesn't look there's a systematic bias of one group of countries against another. We have a little trouble with countries like, I don't know, Latvia and Lithuania, that the time series is kind of short and the data is all over the place, but so is everything else. So think of Latvia and Lithuania. It turns out, if you look at the GDP data, they have big problems with that. And in countries like Latvia, what you'll see will be a positive quarter, a positive quarter, a positive quarter, and then one quarter with -12. So, those little countries are hard to predict anyway. But the big major countries, 12 or 13 of them, we're really pretty darn good at. And I was just looking before I came on here, looking at in 2008, it was clear in France and Germany that by around June 08, the series had collapsed. And by August 08, they were past the highest point the series had ever been in 25 years. So the shape of these series and the fact that, by the summer of 2008, basically for every European country, they were above the peaks that you'd ever seen before. Seems important. The other one, Richard, is actually pretty interesting. Go back to your earlier point. If you go back and look at any of these series, so you have PMIs, you have the Bank of England Aegis model, consumer confidence, and so on, every one of them moved together. All of them were saying the same thing. It wasn't just one of them. They all moved together. The industry fear series, consumer confidence series, PMIs, Bank of England Aegis, beige books, they were all saying the same thing, and the economists missed all of them, basically. But great question, Richard, and you played a major role. But I think of this as well-being equations. This is happiness. This is happiness. This is fear of unemployment. This is firms telling you about their happiness. And it's firm-level happiness data that people haven't really looked at, and the data's great. Thanks, Richard. Good questions. Hope I answered it. We're doing our best, but this is exactly what we're trying to think about. Thank you.
Thanks.
I wanted to ask, what do you feel is a precise mechanism of how it works? Is it that expectations are so predictive because the agents have good foresight, or it's self-fulfilling prophecies that firms expect things to happen and so they behave in the way that it actually happens?
Can I go with this? I mean, I've thought a lot about this. So the first thing, we have a plot in one of the papers where we actually try and look at firms' views of employment and people's views, right? So just think there's firms out there and there's people, they almost are mirror images of each other. So there's a quote in one of the papers by my friend Doug Steger's wife, Beth Steger, who says, people just know what's going on in their local community, right? So that's trying to get at the point of what's going on. I mean, I don't think it's sort of self-fulfilling. I mean, if you go to these EU consumer surveys, which stopped, it turns out, when Britain joined Brexit, so we don't have it since January. So basically, I think what you're getting here is, what do you think's going on? And people seem to know what's going on, and it matches what firms say is going on, which is.
Well, I think Kat is got a good point, though. I mean, that you'll know about the work of Nick Bloom on confidence and investment decisions made by firms. So there could well be a degree to which expectations lead to economic behaviors such as disinvestment that themselves lead to some impacts on the real economy. But I agree with Danny, one cannot discount the distinct possibility that people are picking things up over and above things like disinvestment, and they are walking about feeling things, and that sentiment actually proves to be predictive of outcomes, even notwithstanding people changing their behaviors because of their expectations. But there's work to be done there. So you'll know, for example, there's a literature on, hold on, somebody's got a bit of feedback going on, I don't know who that is, but there's a literature on individuals' quits and separations and decisions regarding investments in firms and the extent to which they are linked to their expectations about labour market outcomes. So I know my colleagues at UCL are working on this, but it's work to be done actually to tease those things out.
I mean, I agree. Let's just think of this. I mean, in a sense, we worried about that, and we thought, once you put the industry fear variable in, that would kill. Well, the surprise to us is nothing kills anything, right? I mean, you would have thought, if what you said was true, right, we would have thought that the people's one was irrelevant and it was just the firm ones. Lots more work to do, but look at the equations. Nothing like that happens. Everything it stays statistically significant, and the coefficients themselves don't move much. So this is obviously intriguing. I think of it as people know in their communities what's going on, and economic forecasters don't.
Let's tell them the one thing, though, Danny, where people can't predict. And this is an interesting counter, because it shows that what we're saying might be really true. The one thing they're really rubbish at predicting is price increases.
So people say, to push back to Richard's question, people said to me, I gave it to a set of central bankers. The central bankers say, oh, it's really all about worries about inflation. Well, it turns out I have a set of papers on it. People are really terrible about it. The first thing is they don't understand percentages. Second, they just don't understand percentages. And I've done quite a lot of work on the Bank of England's inflation expectation stuff. And you can check, you say to people, what do you think the inflation rate is? Right? And they say 58, and it's 1. So the problem is the price. So we've done work on these inflation stuff, and we haven't put inflation in there, but people are absolutely hopeless. I mean, they have absolutely no clue what the current inflation rate is. So if you say to them, what do you think the inflation rate is going to be in a year's time? Well, they think it's 58 now, and they say 132.
What if you ask them the question, we should come on to Maria because she's got her hand up, but what if you ask them the question, thinking 12 months hence, do you think prices are going to go up?
That's what they have.
Stay the same.
So think about, in the survey, you can actually look at, if you say, what do you think inflation is? I can work it out because I know what it is, right? So you can say, okay, within up plus or minus a point. So you're clever. It turns out you have to be able to predict that, to have any predictive pattern about what you think is coming. And the only people who know what inflation is are basically the people in this Zoom. So you have to be young. Well, British are young, but you have to be educated. You know, I mean, so if you can't work out what the inflation rate today is, you can't forecast what it's going to be in the future. But what's so different about it is you can say things like, "What do you think is going to happen to unemployment?" And people are good at it, right? That question they're good at. So we've spent a lot of time, and that price stuff is just garbage. I mean, so A, the inflation rate itself is too high because of hedonics, but B, people haven't the faintest clue what inflation is, including, I have discovered, many policymakers, many Federal Reserve Bank presidents don't understand what inflation is. So the answer.
Let's ask Maria. Let's get Maria she's got a question.
Oh yeah, thank you. So yeah, very, very interesting talk. I had a quick question about the way in which people answer this question. So I was wondering if you can say something about the volatility of these predictions, because is it the case that some people get it very right and some people get it very wrong? So how does this dispersion look? Do you know something about the type of people? And I was also particularly interested if you see that this volatility tends to increase around turning points, just kind of with this idea of the mechanism in mind, and what are, how much uncertainty is there around this?
So this is another aspect of work that we're supposed to be working on with Corrado at the National Institute. So we haven't really been looking at those questions directly, Maria, but we have been wondering whether there's more information in the tails of these expectations. And it looks on first glance, the answer to that is yes.
So Alex is completely right. So think about this index, just to explain it. So the index has 5 options, right? Do you think unemployment is going to rise a lot, rise a bit, stay the same, fall a little, fall a lot, right? So what they do is, Alex showed you that you can create an index, right? You just weight it and you solve a number. But it turns out they actually give you the proportions in each of the blocks, right? It certainly turns out that a really crucial thing is the top category, right? So we're working on, so the people who say, oh shoot, it's going to rise by a heck of a lot, that turns out to be the driver here, which we hadn't realized, but we're working on that now. Corrado has a paper when he was at the EU working on it, but it certainly looks that if people shift suddenly to that top category, that's really, really predictive and bad. But you actually have the data, and if people want it, you actually can download it from the same place.
But I think Maria's point is an interesting one, and it does link to the Blanchard point of, what drives these expectations and changes in them, and, across people over time, whether there's heterogeneity in how people respond to these things. We haven't done anything on any.
Okay, yeah, no, that's good to know. And on your graph, so sometimes it seems that people's expectations kind of overshoot or undershoot. Is this kind of again driven by this tail that you mentioned?
Good question. Well, I think the answer is, and our working hypothesis is that the really important thing is basically if people go, oh my God, it's going to be absolutely terrible. That looks like the really big thing you want to know, right? So we've started to work on, let's take the proportion of people who say everything's really bad. And so that's ongoing work, but Corrado has done some earlier work on that. And you're very right. I mean, in a sense, it's that at the turning points, that's what you get. Lots of people suddenly, in Germany, the thing's low, and then suddenly people start shifting into this, oh my goodness, something really bad's happening. And that looks like, it doesn't look that the other tail does much, like we've shifted and everything's great. That doesn't seem to have any impact. But for us, the thing at the top, so that's what we're starting to do, and Corrado's been working on it. But it's a great point of yours. In terms of the price stuff, let me just go back to that. It turns out that when you ask questions on inflation, you have to tell people, you can't allow them to tell you what you think the inflation rate is. Because if you do, they just say such ridiculous things, right? So you have to actually prevent people giving you, so the Bank of England gives you medians and stuff, and it says, and it's found when it asks the question, it has to limit it to 5% and above, because people say 7,000, right? So it turns out the information in the inflation data in the right-hand tail is non-existent, because it's just, people just say stupid stuff. But in these data, I think it's all right.
Okay, thank you.
Any more?
Okay, we have few more minutes for last burning questions. Richard, you
put this, mute it, Richard. Unmute it, please. We want to hear you. Still can't hear you. Unmute it, Richard.
There we go.
There you go.
I just wanted to come back to our earlier discussion, because I mean forecasting turning points is not the only thing
Right.
that people need to do. So it seems to me that I'm just thinking in terms of arguing your case. What I was trying to get at before was the ability to actually predict year by year.
Absolutely.
Just to compare your forecasts, the totality of your forecast of the changes in unemployment year by year, with other models. I think that's going to get you further in dealing with these model makers.
Richard, that's a great point. That's exactly what we're doing with James. We thought exactly that. I mean, this paper, Richard, just to separate it out.
But sorry. So you said you did that. What did you do exactly?
So
we're doing it at the moment with James. At least he's at the Fed in Cleveland, and he knows.
I see. Yes. Yeah.
His job is to do this. He's one of the guys who does that modeling, Richard. So he's taking it.
Very good.
Fed, so we're looking. He's taking his models and then looking at ours and seeing how we compare. So that's exactly what we're doing. But I think let's just say these 2 points, Richard. And I think you said it really well. We have 3 papers. The first paper is this one that Alex talked about, and this is precisely about modeling unemployment. It's exactly what Richard said. So this is an unemployment equation where we're trying to model the months ahead and so on. So that's the first paper. The third paper is actually more about turning points. So Richard, we're doing both things. This is about, can you predict on monthly unemployment? That's what this first paper is. Understanding what you said. The third one is, can you focus and predict turning points? And then the second one, which we didn't talk about, is about trying to think about what's called the Psalm rule. And the Psalm rule is a rule in the United States where Claudia Psalm says that you can predict unemployment with it. And it's in a sense a negative paper, Richard, I should just say it. So there's supposedly a Psalm rule, which is used to predict unemployment, is used to predict these turning points. But it turned out, we went and asked her, do you know if the Psalm rule applies to any other country? So if it's called a rule, it ought to be a rule that applies somewhere else. So the paper goes and looks at the Psalm rule and finds that actually our model does better in the United States than the Psalm rule does, but also the Psalm rule doesn't apply to any other country apart from Canada. So it's pretty hard to call it a rule. If I show for every European country, it doesn't work. Well, it does work, but it works 6 months after everybody else's forecast. So anyway, so just so you know it, Richard, you don't need to know about the Psalm.
Thanks ever so much. Got to go.
Yeah, good man. Yeah. Anyway, so that's the second one, but there's no Psalm rule, and there isn't such a thing as a Psalm rule because it's not a rule. Well, it's a rule, but it doesn't apply to any other country apart from America. Hard to call it a rule, but that's a bit mean.
That is mean.
What?
That is mean. Anyway, but
great. So unless we have a last-minute question, we 3, 2, 1.
Another chat. What's the third chat?
Yes, I think we discussed all the questions in the chat, and it's people being grateful for the fantastic presentation. So I'm going to join that sentiment. Thank you ever so much, Alex and Danny, for joining us. And I hope to see a lot of you next week when we have a last seminar of this semester. And Christian Crackle going to present his paper on back to Edgeworth. Oh no, that has a question mark. Back to Edgeworth, estimating the value of time using hedonic experiences. So I hope to see a lot of you there, and thank you for joining today. Have a nice rest of the day.